Welcome to Venture Node. We are a Web3 community of founders who are looking to learn from each other by speaking to people who are currently in the trenches of their own venture. Join us today with our guests coming from the Shine DAO incubator, the project RociFi, and their chief product officer, Konstantin, and co-founder, Chris. Now, this episode, we're going to start with some introductions because in the first episode, we did not introduce ourselves, the hosts. So my name is Adrian. I have a background in alternative data, fintech, software, as well as crypto. I recently launched a project over the summer called Black Swan. And this is my co-host, Michael. He can introduce himself.
Hey guys, my name's Michael. I am a crypto enthusiast as well. I do know a fair bit about DeFi and smart contracts. I have worked for several crypto projects in the past, and happy to be here and host this podcast with you guys.
Chris, want to start?
Sure. So I've been involved in the blockchain space since late 2016 in a variety of different capacities, from research to also founding Quant trading hedge fund, and then obviously most recently with founding ROCI. So been in the space for a while in a couple different areas. So I'm excited to be here, talk a little bit about what we're building, but also just sort of shoot the breeze with other founders in the space and other enthusiasts.
Yeah, awesome, guys. So my background has been in product management for several years, and for 6 years I've been debating into fintech and crypto. So been head of product in Creditech, is a German company that built lending solutions in many emerging markets. So pretty much machine learning based scoring based lending in such we launched products such markets India, Mexico, Russia, Poland, so on and so forth. So back then already was super interested how to scale lending products worldwide. And then in parallel got interested with crypto. From 2019 to 2020, I was working as head of product in Bitvala. It's a pan-European crypto trading application, and combining these two worlds, obviously super interested in DeFi since 2020. Been working in the fully regulated crypto trading company. We were just looking at how many things are happening in DeFi, and this got me interested to step into this space. And since last year, we started in the Chainlink hackathon, and later on we were contacted by Chris, and now we're working pretty much on together on RociFi on the Under-Collateralized Loans. So that's a brief story, but we can expand on more details throughout this journey. I think it was super interesting, actually.
Awesome. Yeah, 100%. So actually, Chris, I think we could start with you. We have a couple of questions about your background. I have to say both of you have super impressive backgrounds, serial entrepreneurs. You guys have done a lot. So Chris, with your quant fund and some of your finance background, I was wondering if you could talk a little bit about that, and specifically also the AI standpoint. I noticed a lot of your experience has to do with AI, data research and stuff like that.
Yeah, for sure. So most relevant, my finance experience is somewhat polymath, but pretty heavily concentrated within the credit analysis piece, which applies obviously quite well to what we're doing with ROCI. So I was formerly a credit analyst and portfolio manager within the commercial loan and corporate debt divisions for some of the larger commercial banks that are based here in the U.S. before I ultimately found my way into the blockchain space. So ironically, I didn't want to be a career finance hack, which is what led me to go back to graduate school to get my graduate degree. I got my MBA from Carnegie Mellon, at which time is where I really dove headfirst into the analytics piece, obviously with machine learning and AI. And then, sort of boomeranged back to investment because I dove headfirst into blockchain. So all that sort of confluence of different events to where, my experience coupled with interest in ML and AI, it led us to what we're building at Roci. But yeah, as you mentioned, primarily my experience has been within finance, principally of a debt capacity, and then also from ML and AI different experiences. I worked for an analytics startup that was looking at sort of water conservation that was based out of San Francisco. So that was a very specific subsect. But then obviously what we were doing at my previous hedge fund that I founded, Valley and Darrow, was more on a financial trading application. So we specialize primarily in two machine learning trading strategies, which were directional, not market neutral in nature, and have since sort of taken some of those knowledge, but and transferred it to what we do at Roci. But it's a very different problem set of what we're solving there compared to what we were doing in the financial markets. But yeah, I've got tons of experience in all of that, which is why we sort of took on trying to bring this initiative of being able to facilitate under-collateralized lending within a blockchain native experience, because we felt we had the team and requisite experience to be able to do that.
Okay, cool. So I guess lots of your experience from working at the Quant Fund, you guys would have dealt with a lot of data sets and back testing, I'm assuming. So
Yeah.
and yeah, so I'm sure that you are able to, implement a lot of those skills into Roci as well. So yeah, that's pretty interesting.
Yeah, it's not apples to apples comparison for sure.
Yeah.
But it's data's data, and as you ingest it and analyze it, it's you can get actionable insights from it. The quality in the space, I'm sure you guys are familiar, is something that is getting better, but it has not historically been up to like an institutional caliber. Whether you're just looking to ingest straight exchange data, which is OHLCV, or you're looking to try to actually get info on DeFi data, which is an entirely different beast in and of itself. But it's improving, it's getting better. But the best thing is that it's publicly available. So for those that are willing to kind of do the heavy lifting, it's out there.
Yeah. So yeah, everyone has access to the same data, but I guess everyone does different things with it. I know within the financial markets, I guess more specifically directional strategies. I know a dirty secret that within the quant industry is that there's actually not that much data that can be used, or there's not that much clean data out there when you're looking at different quant strategies, because the markets did change during around 2008, which is when, during 2008, which is when most of the liquidity was overtaken by algorithms. So, and during 2008 to today's date, there's really only, I guess, two major crashes. So you have the GFC and the March 2020 COVID crash. So, I mean, that's not really a great data set to kind of back test a strategy and put it through a good amount of stress tests, because you want to be able to test a strategy during 100 crashes or 100 different events, right? So there actually isn't that much data out there. So have you guys noticed similar issues when looking at the lending space?
So I think I guess it's interesting to unpack that just a little bit. So in terms of data, and again, I never traded within the traditional markets, so I'm probably not the best person to speak on it. But from from a data structure perspective, for the most part, there's the behavior of the participants has adjusted within that particular time frame, which has been exacerbated by some of these exogenous forces, whether that be the proliferation of high frequency trading, or the fact that, post 2008, there's been a big influx of fiscal and also monetarily driven capital within the system, which has sort of boosted asset prices with you sort of name it. But historically, the distribution of that data set will be relatively similar. I think what is probably dissimilar to what is going on right now is the frequency of those types of cycles, the cyclicality within the data that wasn't seen previously from the 80s, to 2008, because you essentially had this smooth path where credit was expanding from a relatively low level, but then also at the same exact time, interest rates were gradually marching towards their zero barrier. That's just my particular, and it's interesting to think about it from an economic history perspective. But to your question, not really, if I'm being honest. I think there's an issue of data. So I'll take that back. There's an issue of behavioral, like, data perspective, because the market sentiment sort of change. I think now potentially the markets are a little bit less sensitive to price sensitive investors, whereas 2018 and then to probably 2020, it was very dominant, where people were in it because this is a new asset class, store of value, and all that sort of stuff. Where I think more now it's being viewed from a technology perspective, which rhymes more with a venture capital, high growth tech investing cycle, less with a cyclical macro view. So the behavior does change, which can be difficult for models and modeling. But for the most part, it's, markets are markets, distributions are going to be distributions. And given this particular market is less affected by some of those exogenous forces, you see the cycles and the volatility happen more often, which actually is more robust for the market, makes it more resilient, and also makes the investors and the participants within that particular market more resilient as well. So yes and no, in kind of a long-winded way about that.
Okay,
Yeah.
cool.
And Konstantin, I know you also have a background in credit research as well at Credit Tech, and also Bitwala. So I wonder if you could talk a little bit about your experience at Credit Tech, and then we'll get into Bitwala as well.
Yeah, absolutely. So in both Bitwala and Credit Tech, I was most responsible for the front-facing applications. So pretty much my part in Credit Tech has been working with the loan application side. So how we pretty much attract the clients, the borrowers, and convert them to the actually taking the loan with Credit Tech. Obviously, that's been I think we had I'm really proud of that. We had like one of the most lean lead cycles on the market. And literally, for me, my work has been to make sure that it's very easy for our clients to fill in the application. But at the same time, we always, as I mentioned, it's been pretty much based on the data set that we collect through the lead cycle, that we would be able to score clients. Of course, there would be also necessary data that we need to collect. And the work that we put up was pretty much to have this expandable, and which would be possible to launch several markets very fast, like deploy to new markets very quickly. And the background, of course, there would be several models which would be scoring clients for different markets. So that's been my focus at Credit Tech, and more like interacting with the data science teams in the company. Similarly, as well, like in Bitwala, it's been pretty much Bitwala is interesting from the side that it's tried to combine two worlds, like the banking world, very regulated, and integrating the crypto trading within this regulated environment. And I think the product is very, very unique still, like in terms of like being able to trade directly from your bank account, and also unique in the terms that it covers all European markets, EU and EEA. And also we we're integrating, for example, we're working very close with Celsius. So the Celsius product is integrated directly with Bitwala. So Bitwala is the exclusive provider of, so to say, Celsius offering in the EU, Germany. These were very interesting products that we were working on.
Yeah, no, I think being in the regulated crypto space and working with banks and stuff like that, that's probably a huge advantage that a lot of DeFi players don't really look into that much. But just quickly, I wanted to go back because you mentioned at the beginning how you met, and it sounded pretty interesting about a Chainlink hackathon or something.
Yeah, sure. I'm happy to tell my side of the
Yeah,
story.
go for it.
Yeah, so pretty much we started a year ago. Actually, in March, we joined Chainlink Hackathon. I went there to pitch about under-collateralized lending and build up a small team over there. So our lead developer is actually the one who we started working there. Yeah, and then we started working on the brand Lone Wolf. And actually, Chris contacted us through the submission because Chris and Seed started working from their side on under-collateralized lending, and they already developed pretty advanced again scoring system while we started working on the lending piece. And over the couple of months later, we reconnected and found out that that actually these pieces really come together. So Chris offered us to work together. Since then, since end of August, we are working under the same roof on the same brand, RociFi. And that's pretty much the story. So the core team is consisting of 2 people from Lone Wolf and 2 people from RociFi originally. And over the course of several months, we already grown to more than 10 people in-house, covering pretty much every single piece that is and skill that we need right now to launch to the market.
Yeah, I mean, I think he hit the nail on the head. We had the analytics piece. Lone Wolf, had the lending architecture, the Solidity dev piece, and it seemed like there were synergies there. Konstantin and I both got along, so it made sense for us to merge forces rather than look to compete.
Got it.
Okay. Cool.
So Konstantin, I guess you had more of the background with the Lone Wolf infrastructure, and then Chris, you were more focused on the actual like credit scoring on blockchain. And I assume you were both already kind of working on this separately, and then just decided to join forces because it made the most sense.
Yeah,
I think Chris' team was more advanced with under-collateralized piece. Eventually, we actually, after the hackathon, I mean, there has been really great interest also from investors who contacted us. And I think we realized actually that we need to start from lending. And we started, serving other companies with the building, so to say, the product for them based on the smart contract-based lending. So kind of a little bit deviated from the original idea, but was super happy to be again back in touch with Chris because that's bridged us to the beginning. So from what had been started, so was absolutely excited to continue working with Chris on this.
Yeah, guys, how has launching a crypto startup compared to working in like traditional finance, for example? Have you guys noticed any major differences or maybe some advantages or disadvantages when comparing the two worlds?
I mean, from my experience, it's pretty different. It's pretty fast paced, in a variety of different ways. There's a bunch of things popping up that you need to constantly sort of keep your eye on as well. So I think it's very different from a pace perspective, even probably from a traditional venture capital backed startup, which I have experience in as well. I think it's even faster than that. But some benefits that you can get, dumping out of a traditional finance world into DeFi or blockchain or crypto, whatever it may be, is just a little bit of a different perspective that can sometimes round out that move fast and break things sort of mentality. I don't think that is necessarily a negative thing, but there can be a lot of fruitful things that can be missed if that is your only experience with the world. If you've got other experiences, like with any other aspect of your life, where you've taken some lumps and there's been value added to your character or professional experience, that can only help with your decision making and the choices that you make to ultimately stand up. So that's just my particular experience on it. But yeah, there's pros and cons like everything else in life.
Yeah, I think this is a really good question. Thank you, Michael. So to be honest, I think about this pretty much every day because I have to constantly adapt my thinking and ways of operations to this new world. And I'm happy to do this because I believe this is actually the new world. Like this is how overall, company building, team building, customer development will be done years ahead. So we are basically into the intersection of changing two worlds. So, and I can give you a few examples. So, literally, what I like actually to be the most is like community-based product development. So, we also made this our goal to go to the market as soon as possible. Obviously, there are a few things that we really need to ensure, like for example, absolutely security of smart contracts, audit that needs to happen. But still, our goal hasn't been like developing a product for months or years, but bring it to the users as soon as possible. So again, happy to announce that we already have the closed test net, and it's going to be open by end of this month. So anyone can try and go through RociFi product already at the end of this month. And this is what we want to. This power of community is incredible. Like people are honestly interested in things, and it's super efficient to reach out to people and ask them questions, get their feedback directly. Usually, proactively, people try the product, which is usually more harder in the traditional world. I experienced this in both companies. To reach your users, you need to set up focus groups. It's a lot of preparation, work with agencies, like quite a lot of inefficiency in the way. So this I personally like the most. I think raising money, obviously accessing capital is very also different. Like I think we are blessed to have somewhat easier environment, and absolutely I saw projects that again hasn't had yet product delivered, but we are able to raise through IDOs and so on and so forth. So like this is embedded already from day one. You can access capital in various ways. This is absolutely also enables things. I think what has been a little bit like a drawback, of course, it's a lot of noise. Obviously, yeah. Like you need to cut through the noise and both in finding great people, but also being able to understand what's going on in the industry. I believe that every company needs to have a few full-time analysts just to analyze constantly what's happening in the industry. So new projects pop up, there is a lot of distraction going on. You always need to know and try things out to be able to develop your own product and have a real assessment where your product is in comparing with others and so on and so forth. And I think maybe the biggest headache I had personally was again like to find out how do we structure the team, what kind of people we need, and how to we bring people from the traditional background, how to make them feel good in this industry, right? And similarly, we would be in development and say in growth and product. We also meet a lot of talented young people who are really knowledgeable in crypto world already, but they probably lack a little bit of so to say experience in the traditional company building and working. So this is probably the most difficult part, like how to structure the team that it's from one side there are people who are think already as crypto native but still have a solid experience and background working in the traditional industry.
Right. There's so much access to capital in crypto that I think that's what can be attractive to a lot of people from other spaces outside of crypto. But I wonder, if you're trying to attract a lot of people from traditional finance or other industries, like what has been the biggest draw to joining RociFi or joining into the crypto industry compared to what they were already doing before? Would you say it's the access to capital, the innovation? Like what's the biggest attractor?
Yeah, I personally think it's curiosity. So I'm also like I should say did this move over the couple of years. I really like to meet people and talk to people, and for me this is a great advantage. People are curious but what's happening in crypto, because many people believe obviously that it's going to change the financial system. So why to wait several years before someone else makes the space? Why not to pretty much come and learn over there, even though again there is a lot of noise, lots of learning needs to happen. But I think that's the biggest kind of attractor. People who are curious, they will find their space and they will find the motivation to learn and get into the space. But for sure, there are things quite different, and it takes a lot of patience from people and also a lot of efforts to be able to digest things that are happening here. Yeah.
Yeah, so I guess
Okay.
now we can get into the under-collateralized loans, because that's obviously a huge topic and there's a lot we can cover there. So Michael, you wanna start with the first question?
The first question should be about how you guys view digital identity and on-chain identity, because I know that is one of the main data sources that you guys use to evaluate creditworthiness for these loans. So yeah, maybe you guys can give a little bit of color on your thoughts on on-chain identity um, and how you guys plan to use that.
Sure. So just to unpackage it a little bit, on-chain identity is very useful. So whenever the core hypothesis that we sort of launch ROCI with is that there might not be a big depth of data from a time series perspective, given the space has only been in existence since Bitcoin, but also the DeFi space really has only been in existence and utilized probably for the past 3 years, principally on the Ethereum network. So there's not a big depth, but there's a big breadth of data and also independent users who interact with different protocols and different behaviors within that particular ecosystem. So the core hypothesis was that there is enough data there for us to be able to analyze it, to be able to make credit decisions. That piece proved out, and we actually put out sort of like a credit score white paper, kind of walking readers through our process as to how we do that, but then also some of the preliminary results that we did through that as well. The additional piece that we layered on top of it at a later date was what you're talking about in regards to online identity, because we looked at the benefits of what was being built in Web 3.0 and metaverse and all these different things. If you strip away some of the more speculative things and get down to what it can potentially enable, the proliferation of reputation through online or on-chain identities was one of those things. So that sips at, if you think as our process to attain under collateralized loans as a funnel, the on-chain identity kind of sits at the top of that funnel so that ROCI knows that this person or institution or individual borrower is in fact reputable based upon some of the individual online identity components that it chooses to connect within ROCI and validate and verify that they actually do belong to them, for us to know that this institution or individual is in fact reputable, meaning that they won't just simply take an under collateralized loan and run off with it. And that can be through the fact that we know that this is tied to, let's say, an Arlington Capital, an institution that has wide repute, or this can be an individual that has a large following within Twitter, which is also tied to an investment fund or a protocol that has, again, a high reputation, meaning that if they were to default on a loan and we were to dox that particular information through our channels, which will do in the event of a default, they stand to lose a monetary value of all these different types of things that they have their hands in addition to their reputation score. So that kind of brings everything in together of this social recourse component for the communities that these users are engaged and involved with to sort of self-regulate and self-govern themselves. So that sits at the top. And then ultimately, if you pass that particular piece. Then you go into the credit scoring element to where our scale is 1 to 10, with 1 being the lowest credit risk and 10 being the highest credit risk. And ultimately, based upon your score, that is where you'll be routed in terms of what your collateral ratio will be for a potential loan, your potential loan size, and then also what your interest rate will be for that particular loan as well. And the reason why we've broken it out is because I'm sure everyone here on this call knows of highly reputable people that they love and trust in the real world, but they don't pay their bills on time. So the pieces need to be symbiotic, but they also need to be exclusive as well. I don't think it works for you to just look at someone that is highly reputable and then let them max out under collateralized loans or zero collateral loans to the gills and expect a positive outcome.
Yep, I see. Okay, cool.
And would you say that, because I know you mentioned, well, first, I guess, could you go over like some of the, do you have the specifics as to what metrics you're looking at in order to determine the credit score for these wallets, or is that still being tested?
No, we have the metrics. We don't open source them as of right now for obvious reasons, because if everyone knew exactly what they were,
Got it.
then nefarious actors could game the system to be able to take advantage of it. But what I always tell people is it's all the sort of features and factors that you would suspect sort of evolve creditworthiness. So again, if you've interacted with different DeFi lending protocols and you've been a good participant on those, it is a positive. It's only going to benefit your particular credit score in some broad stroke. So that's typically what I say. If you have never engaged with a lending protocol, then how are we supposed to know whether or not you taking out loans is actually a positive thing, that you are credit worthy, and so on and so forth as well. So yeah, I always tell people that it typically falls into what you would suspect would be indicative of positive credit behavior.
Yeah.
And out of the, or sure, go ahead.
Yeah, just to add here as well that our vision is to have ROCI's credit scores more ubiquitous, obviously, in DeFi ecosystem. So pretty much that other protocols in the future could also do certain judgment based on the credit score done by ROCI. And by the way, ROCI's credit score is a bundle of several addresses that you use. So it's not only tied to one address, but several addresses on Ethereum blockchain. And that would pretty much define kind of your reputation as well. And you would be, if you want to cheat and default, then for example the cost of changing your wallet will be much higher, for example, than the cost of funds that you might steal from us.
And out of the, I know you guys have analyzed this credit score, I assume, with some of the white paper information that we were looking at. Out of the wallets that you've analyzed in the blockchain data, like what percentage of wallets or individuals do you suspect would qualify for these under-collateralized loans as opposed to the over-collateralized options that you have within your credit scoring system?
That's a good question, and I don't know if I have specific data off the top of my head, but again, probably a generic response would be it follows just what the normal distribution of statistics is in the real world. So probably 80% of the DeFi participants are probably average at best, right in that meat of the bell curve. And then the bottom 10% are just really, really bad. And then you've got the top 10% that are probably really good or exceptional. In order to mitigate risk at the early stages, we'll probably focus and concentrate within that top 10% of being really, really good, just because we know that they're probably going to be quality borrowers and won't have to really worry about any negative outcomes. Obviously, we still need to mitigate risk appropriately, but we don't have any data. But for the initial terms, that's probably where we'll focus, and I suspect that the rest kind of conforms to that normal distribution of bell curve, and then we'll gradually relax and invite more people in over time as the protocol scales and gets more traction and we figure out more unknown unknowns.
Yeah, and pretty much, yes, the score, we can always move the dynamic scorecard, sometimes allowing under collateralization in the beginning, so to say, to less amount of borrowers. But then eventually, as this proven, we obviously need to improve the algorithm, then we can also increase the scale of the borrowers that would be accessible to under collateralized lending. And this is also, I think we didn't mention that the structure of ROCI is that we will have different risk pools. So for each stable coin to be borrowed, there will be underneath 3 different pools for the start, which are classified by the risk. So as well, the investors can choose where to deposit their pools. Obviously, you are eligible to higher APY, but as well, there might be the APY would be lower if there are defaults in these pools.
Okay, nice. I would like to ask, because as of right now, I don't know of any other protocol that's doing uncollateralized loans. So I'd like to ask, why has nobody solved this issue yet? Is there like a huge hurdle that has to be passed? And once that hurdle is passed and someone does solve it, how will this change DeFi lending? Is it going to boost the adoption massively in some way, or so how do you guys see that?
Yeah, the principal hurdle as to why no one's done this before is the recourse element, because
Yep.
you don't get a chance to see that, like, oh, this is Michael on the opposite end of the loan, and maybe I know some off-chain data about him, like his FICO score or anything like that. We just see a string of numbers, 0x, blah, blah, blah. So the pseudo-anonymity is to why we kind of have this pawn shop market to where over-collateralization is kind of the standard, the modus operandi within that. So again, being able to combine all these pieces that we're doing in terms of online identity, but then also understanding behavior, it allows us to make sure that we're only accepting and onboarding the best borrowers that have the lowest probability to actually change their behaviors based upon under collateralized lending. So there could be a subset of the data to where they just took under collateralized loans and didn't do anything nefarious on it because they didn't have the opportunity. But the fact that they can now get that has the potential to change their behavior. So all these things need to be taken into consideration, which is why we do it from a very layer cake type perspective to make sure that we have risk management buttoned up from top to bottom. And again, this social recourse component that we talk about, as that gains more prominence and ROCI really helps spearhead that initiative, that is really going to be something that enables and becomes more of a recourse that you would see in the real world, but on Web 3.0 or in the metaverse. Because if more and more users are coming from off-chain on-chain, then the reputation and their credit scores and all these different things that we're helping bootstrap are going to matter more and more. So you definitely don't want to damage that, especially if you burn a wallet address that has 180 days, 300 days, 500 days of history, and all of a sudden that just goes poof up in smoke, along with your ENS, your Twitter handle, and all that sort of stuff as well. So that is at a high level as to why it hasn't been done previously. That is why we're taking the very layer cake approach to be able to solve it. And whenever we do that and prove it out, whenever we launch over the next months or so, it is going to unleash the next tidal wave of capital that is going to come into DeFi, because I think a lot of existing DeFi power players, but also TradFi that's kind of chomping at the bit to get involved, is waiting for that because they don't want to do 150% over collateralization. They want to be able to come in from a semi-native experience that they're familiar with in the traditional world and Roci will be able to provide that. And I think that's going to unleash the next tidal wave.
Absolutely.
Okay,
I would
cool.
just add that it's like it just needs to happen in order to DeFi to grow and become more mass adaptive. It needs to happen. So, and we obviously want to be in the foundation of this, and we are developing the primitive that we believe also other things will be, and other use cases will be built upon. So, also super curious to see how this will evolve and what kind of use cases will this enable in the future. Like specifically, we, for example, already discussed with use case of DAO-based lending. So there are like quite niche use cases which can be growing pretty fast in the future.
So I understand that a majority of the data that you would be looking for would be on chain, but you also mentioned some other aspects like potentially like connecting your Twitter or other reputational factors. So what are the advantages to using on-chain data versus off-chain data, and how much off-chain data would be involved? And also, how does this connect with machine learning?
So I think the advantages of using on-chain data, it makes it more difficult in the short run because you're essentially you're doing something that hasn't been proven before. So a lot of investors and even participants in the space want this to happen, but they just want to kind of birth into existence. So Roci took the standpoint is that like we're going to try to solve the hard problem from day one because ultimately that will scale more. So it's a little bit more difficult in the short term because we don't have some of these off-chain data pieces to connect into, but it allows us to scale that much faster in the future because if you just look at the trajectory, more and more people are coming off chain on chain. It's not going the opposite way. So it's like saying whenever Ford was making cars, they're like, well, if we just study horses, and carriages a little bit more, that will help us build better cars. It doesn't really make any sense. So if more people are coming on chain, and again, they interact more, their online identities and their metaverse communities matter more and more, then why wouldn't you want to analyze that data and have that sort of understanding and core competency in intellectual property as your core like competency of the protocol versus watering it down or saying we'll start with a simple problem of off chain and then we'll gradually integrate some of this on chain, this pesky on chain stuff at a later date. It doesn't make sense from us from a strategic vision perspective of where like Roci is ultimately going to. So we're willing to solve the harder problem in the interim, maybe get scoffed at a little bit and say that can never happen, or there's too many red flags there, this, that, and the other, to have that trade-off in the short term, because we know once we get past it, validate it, then sort of sky's the limit. You kind of see that hockey stick trajectory. But that's my particular opinion on it. And ML kind of focuses at that same exact piece. I think everyone here understands that the value of your model is only as good as the data that you dump into it. So if I'm trying to understand on-chain behavior and I'm dumping off-chain data into it, of course, I think there's enough overlap to where it can be useful from a predictive standpoint right now. But ultimately, that is going to decouple, and it's going to decouple faster than I think a lot of people give it perspective to. So again, you're kind of, if we're trying to build new cars at the Ford factory, we're not, looking at the stables in Kentucky saying, "Oh, that's a pretty good thoroughbred. Let's understand horses a little bit better." You're looking to the future, and I think that's what we're doing right now. And that's just my perspective on it.
I assume that when you offer under-collateralized loans, the liquidation levels and slippage will be different compared to over-collateralized loans, right? So I assume the liquidation levels will be higher than they were previously with normal loans, and slippage would also be lower. Is that correct?
Could you comment on that? That's a very good question, honestly. And since we also offer fixed term loans, so in the beginning, the launch will be basically offering 30 days loans. So you have to repay it after 30 days. Otherwise, that would be certain additional fees that you would need to pay on that, and obviously social recourse would be in place. So it depends, so to say. The short answer, it depends. There are a few roads how this could go. It would not work as exactly as a typical, liquidation that we see in the over-collateralized loans. So sometimes it's makes sense, obviously, for us to let person to repay if it's, for example, the value of collateral dropped very close to the repayment date.
Because I also noticed that even with some of your lower credit levels, that there would still be higher loan to value than some other like comparable protocols, and I think that would be like one of your selling points as well, even for people who had lower credit rankings. And so, like, how would you handle slippage if those loans were to get like substantially larger? Because normally, like, the reason why these other protocols have, like, let's say 60% loan to value is so that if it does get liquidated and there's a ton of slippage, then they can still get that money back. So how do you plan on tackling that issue? Or would it just be you still think it would be profitable in the long run, even with the higher loan to value?
We think it'll still be profitable in the long run with the higher load of value. So a good example as to like why this can still be done efficiently and highly profitably is looking through the credit score white paper, essentially. So because we have the analytics, it allows us to be able to offer higher LTVs while still managing that margin of safety, that if there is one of those instances where slippage or even just market dynamics would cause a loan to where the value of the loan exceeds the value of the collateral, the amount of money that we're making in all these other areas far exceeds that. And we even, took into consideration loan losses within that particular paper too. So we do suspect that at the early stages, given we are going to be very focused on the highest creditworthiness or creditworthy borrowers, just to mitigate risk and again, learn some of the unknown unknowns. But even for those that might be precluded from that in the earliest days of our launch, still will have access to higher LTVs than what they can get probably in 99% of any other lending protocol out there, which can be a good sort of gateway for them to build up their credit history within the ROCI ecosystem, and then gradually move down that credit score scale into the under collateralization phases or rankings as we gradually relax those particular constraints. Ultimately, we'll move out of the over collateralized lending business, but this is a great sort of conduit to kill two birds with one stone in the early days while we're still trying to learn and make sure we hit the ground running, but we don't get over our skis.
And would any wallet be able to potentially take out a loan on RociFi at the beginning, or would you? I know you mentioned you wanted to focus on the higher quality borrowers at first and then transition. So would it be open to anybody, or would it only be the higher?
Yeah. Any wallet will be able to take out a loan on ROCI if they want to. The quality of that particular of those particular addresses that the borrower chooses to bundle and the history associated with that will determine whether or not they're eligible for under collateralized lending in the very earliest days. But anyone will be able to come and take out a loan, and based upon their risk score, they'll be allocated to the appropriate lending pool that has the commensurate collateral ratio as well. Again, over time, as we grow and scale, and again, this isn't a long process, over these coming months within this year, that will gradually be relaxed more and more, so that in theory, everyone on scales of 1 to 10 will be allowed to have some sort of access to under collateralized lending in the grand vision of the future.
And just to add also to Michael's question, so our data analytics piece already leveraged data across several L1 and L2 chains, so to say, polygons and BSCs of this world, and analyzes interactions with multiple leading DeFi applications on these chains.
Okay.
And you mentioned a lot about the social impact that would come with not repaying back a loan, or taking out an over collateralized loan or under collateralized loan and then not paying it back. But what impact would it have on the protocol itself? If someone doesn't pay back their loan, would they be blocked from the protocol from that point forward? Would there be a way to like rebuild their credit? How would that work?
So for sure, like basically every time you before disbursement, we would check your credit score. So obviously we make sure that there is no way to trick this, and to cheat the system. So like if you already have a loan non-repaid in time, you will not be able simply to take another loan for sure. There will be certain limits also in place, and in terms of again, we believe in integration. So in the future, this should be also used by other protocols, and you might be also restricted by certain services in our partnered network. And as well as Chris mentioned, that again, that will simply damage your reputation. Like we've seen already some scandals, obviously, over a couple of last weeks happening in DeFi. So people with bad reputation getting access to certain very sensitive data. So we also believe that would be your kind of litmus test here. If you can repay the loan in this industry, then you have a good reputation and you should be trusted. But otherwise, if you so to say cheated once here, why someone should trust you over here? So if you say a member of Shinedown, for example, and we don't know your identity, but you have a good repayment history with RociFi, that should potentially also at least not close your doors in other projects.
Yeah, I just to add on to that, I think it's important that we that the protocol has a heavy hand at the beginning, because
Yeah.
there's going to be a lot of potential bad actors that are going to look to take advantage of this system. And that's unfortunate because, as we mentioned previously, this is something that the space 100% needs in order to realize its true vision as to like what DeFi can be. So I think it's our responsibility to have a heavy hand to really disincentivize these bad outcomes and these bad actors, so that we can make sure that we bring this ultimate vision there. And maybe at a later date, 5-10 years down the line, we can revisit this to where people can potentially look to rehabilitate their credit, especially if it was an organic default, meaning you just took out a loan and you just got over your skis for some reason. You were high yield farming and you lost a bunch of money, whatever it may be, versus someone or some entity that deliberately defrauded us. So the inorganic defaults, I think there's zero tolerance for individuals or institutions like that. But for more organic type, then maybe there could be an opportunity for rehabilitation in the future. But I think for right now, for the foreseeable future, it has to be a heavy hand to where they can no longer borrow from Roci any longer. And then also try to incentivize and create a network effect of other protocols for participation to box them out of other DeFi avenues, so that it becomes more similar to what you have in the real world, so that no, you just can't go to another under collateralized lending protocol, or you just can't go to Aave or Compound or Uniswap or something. You're now, that address or addresses is now radioactive, and you have a very hard time, including your ENS or whatever it may be. You're going to have a very hard time tapping into and leveraging all these great resources, which are only going to grow in utility and usefulness in the future, again, as more and more off-chain borrowers or off-chain participants come on-chain and look to participate, live, dwell in the quote-unquote metaverse or Web 3.0.
Yeah, sounds interesting. I noticed that you did talk a little bit about bad actors within the system. I would like to ask that, do you guys see possible risks of contagions and positive feedback loops of liquidations? Since the loans are under collateralized, such events can be they can be pronounced, if you know what I mean. Do you see that as a risk?
So if contagion and pronounce, if you mean from the perspective that people will take out loans. They have greater leverage for potentially their speculative activities, and then those
Yes.
counterparty, yeah. Of course, anytime you're in the lending business, you're gonna have issues like that. So it the onus comes on the protocol to be able to understand those particular risks, whether it is the full picture of their credit risk, meaning where do they have existing loans on within other DeFi protocols, or whether it be centralized exchanges as well. So where is their existing exposure at? What would be their exposure if we funded the loan request of what they're doing? And then making sure that there is an adequate margin of safety based upon some sort of shock value or shock factor, assuming that shit hit the fan and the monetary value of their positions, of their liquidatable positions, decrease by 20%, 30%, 40% in an instant. Would they still have enough free capital that they can liquidate and still make good on your loans? Whether it be for us, but then also all of its other loans across all of the other different counterparties that it has. Being able to understand this holistic type approach is fundamentals of credit analysis, which again comes back to the perks of having an experience outside of just technology or whatever it may be. So yes, there is a heightened risk of that, but the onus is not on the individual, because they're going to do what they want to do, whether it's to yield far more or deposit into Anchor or whatever it may be, or even finance positive outcomes like innovation or salaries rather than selling tokens out of their treasury. The onus comes on the protocol to be able to understand that risk holistically and then make sure that it is capped. The loan size is commensurate with what that potential shock value could be, as that falls in line with their credit score as well.
Okay, sounds good. I'd also like to ask about the future of your project and at the current stage of where you guys are at now. So, do you guys have like a roadmap or a timeline on when you guys plan to release certain parts of your project? And yeah, what do you guys have now specifically that maybe people can or cannot use? Um,
Absolutely. So currently, the protocol is already available on Quant and testnet. So at the moment, Link is internal. So we have a bunch of internal beta testers being able to use it. It's been released in the beginning of January. So you can actually already on Quant's testnet with fake stable coins and collaterals take out loans from different risk pools. Our credit risk API already is live. So basically, you can connect your wallet and it will be scored. You will get your own score, and you will mint your non-fungible credit score by RociFi by bundling several addresses together. So that's already live, and it's going to be opened up by end of February for public usage. So it will be announced on one of the future AMAs that we're gonna have. So product will be available for testing, for usage, for trying out, and we are currently in the process of audits from a couple of leading firms. We pretty much familiarizing right now with the results that have happened during their audits, and upon making those changes and passing the risk lead audits, we are gonna release in mainnet, which is going to happen in Q2 2022.
Okay, sounds good. Do you guys have like a chain that you plan on launching on first, or because I know you guys plan to be chain agnostic? Do you have multiple chains, or which
Yeah,
one?
so we'll definitely launch on Ethereum mainnet and probably some L2
Yeah.
initially. The biggest that's kind of to be determined over this next month process. But the biggest thing for us is our rich data set is principally within that EVM compatibility. So for the initial future, we won't be able to sort of launch on any chains that are not EVM compatible because we won't be able to see principally their credit history. But as that becomes more standard, which you're already seeing labs built out for Solana, Algorand, and so on and so forth, in theory, we'll be able to hit that vision of being entirely agnostic. But yeah, for the initial launch, it'll be Ethereum and probably some other L2.
And where do you see the project in? I know timeframes in crypto, everything moves extremely quickly, and in the next couple of months, even the project could change completely. But where do you see yourselves in like the next year or 2 years with this project once you have the under-collateralized loans out and as everything gets launched?
So yeah, I mean that's a sky's the limit. Essentially, what we're doing is we're laying the foundation for us to create a decentralized like credit economy to be the layer one for that, which everything can sort of bolt on. So if you think about all these really disparate um, pieces of financial architecture that is in the real world, they're absolutely enormous and they're controlled by different jurisdictions, governments, whatever have you. But just imagine the power to be unlocked through more of a decentralized perspective. So what we're doing right now is just the base layer to be able to bring that vision to life, because you need to be able to accurately score and assess credit worthiness, but also 99% or whatever it may be of the actual credit that is outstanding in the world is all under collateralized in some frame or fashion. There's very little over collateralized loans. So that is the first piece that needs to be solved. And then once we do that, show it, and then gradually scale it, then all these additional pieces can be bolted on to bring sort of like that general credit economy vision to life. But Roci is positioning itself to be that main layer, so that other protocols can build on top, whether existing or new, and gradually take that vision to life. We're willing to sort of put our money where our mouth is and solve the hard problems first, so that everyone has a certain layer of comfortability, knowing that whenever of what they're building on from there. But yeah, sky's the limit to where we're going to go with this. We're shooting big, but also we're in the trenches trying to solve the hard problem, so that these next steps over the coming months and years will be easier for other participants and potentially can get some new outcomes that we didn't foresee as well.
Konstantin, do you have anything to add?
No, no, I think you can just double down on what Chris just said, and eventually, I want us to become the foundation of the trust ecosystem also in DeFi. So, as I mentioned, pretty much like I think what we mentioned about social recourse is a new habit, and like what is obviously most difficult part in product development is to change the existing behaviors and create new habits. So once you create new behavior, a new trend, then you're ahead of the game, and that's what we eventually want to do. And you're absolutely right, things can change, and I want to think that actually our vision stays like this, but we will be absolutely that's why it's important to put out our product now in public, because as I mentioned also in the beginning, it's important for us to observe how this will be used, and exactly observe new so to say trends and new habits that and new use cases that will be created on top of this.
Okay, cool. I would like to ask, do you guys plan on launching a token? And if so, what will the utility be for it?
So we do plan to launch our token. It'll be some date after our main launch, still sort of TBD. The utility will be principally governance, but also there'll be a staking component attached to that, to where holders and stakers of that particular token will be entitled to some sort of percentage of revenues that flows through the protocol, and also the stakers will be the sole holders or the sole participants that are able to vote and implement on governance matters whenever the full DAO is implemented. So which assets, updates, this, that, and the other. So yeah, those are the main components of the eventual native state or the native token that we launch.
Awesome. Well, I mean, everything sounds super interesting with what you're doing with RociFi. Sounds like a super exciting and innovative project that we are definitely going to want to watch and follow along with what you guys are doing. And also, I know with your super impressive backgrounds, I'm sure, this is a very difficult issue, but if anyone should be able to do it, hopefully it will be you guys. So yeah, we're excited to follow along with what you do. Maybe we'll get you guys on the podcast again in the future, but we really appreciate you guys coming on.
Thank you for having us. It was a pleasure to be here. I really appreciate it.
Thank you, Michael. Thank you, Adrian.
Thanks,
Awesome.
guys.